Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show. Corey Fleck here, host of this weekend's edition. Shadow's unfortunately a little tied up this week due to Thanksgiving. For all our U.S. listeners, I hope all of you in the U.S. had a very special Thanksgiving. Even in Canada, I celebrate Thanksgiving by smoking a couple turkeys, all from my time spent down in the U.S. when I was in university. This weekend show very much focused on looking big picture at markets and metals. Going to start off the show with Rick Bensignor, president of Bensignor Investment Strategies. Rick writes the institutional newsletter, Supposedly Irrelevant Factors. That is read by some of the most successful hedge funds in the world. On the retail and individual side, check out the In the Know Trader website, which I will link to in the show notes. Rick has 3 products. One being 7-Eleven Ultra. This is where he is now constructing a portfolio like a hedge fund would build so that you can follow along and not pay hedge fund fees. There's also the weekly report called the Tactical Trader Report and the daily tip sheet that Rick more recently started. Rick, let's start off with the commodity sector. You know how much my audience likes talking commodities, especially precious metals. Let's start off with gold. Gold is, I guess, kind of choppy sideways, hasn't hit an all-time high since really the tail end of October, but it's been a very good year, especially the last about 8 months for gold. Rick, what's your takeaway from this choppy nature in gold's price?
So we've been telling clients for quite some time that if gold got to 2,700, that you'd want to take some profits there. And I'm talking about, I don't mean trading profits from a month earlier. I'm talking about, if you're long gold from well lower. I personally sold about half my gold at 2,700. I watched it trade at 2,800. Since then, it's traded as low as about 2,550. And right now you're at, 2,670, give or take. And I'd say that you're still in this consolidation phase after reaching what I believe is, kind of a decent top. And that's a top that was not only suggested from measuring techniques that I have, when you're at an all-time high, obviously you can't reference some prior high to lean against. These are all projections of trying to guesstimate where a market may run out of steam. And I had multiple time frames and unrelated measurements that all came in both from a timing perspective and then an actual dollar perspective. From 2716 was the highest, and I think it was 2662 or 2682 up to 2716. So that's where I'd recommended people taking some money off the table. And I tell you now that if gold takes out that mid-November low of roughly 2550, it should fall, I would guess, another minimum $90 or so, somewhere near 2460. Would be the first of the downside targets measured off of the high. At this point, you've got resistance, obviously, in and around 2,800 to about 2825 or so, just off of that all-time high. So I'm not in a rush to buy gold here. I get the longer-term case for it. I always have. That's why, I've been long for many years. But there are actually times and places where it makes sense to reduce, and you only do that if you think that you can replace it at a decent enough level underneath that it makes sense, especially if it happens to be in a taxable account. If it's not a taxable account, then you can kind of buy and sell and you don't worry about that. But if this has been in a taxable account and you sold, and you're going to pay long-term capital gains taxes, then you kind of want to have a decent sell-off to make it worthwhile to get that. And I'm not saying we're going to get a 30% decline or a 40% decline, which is probably more close to where people are going to pay taxes on, but it had reached a point where enough bullishness was present on top of all these projections of where gold was going to go and that it was going to hit $3,000 within another 6 months. And that, yeah, maybe it does, maybe not. I'm in the camp that I don't have an issue taking some profits. And I'm happy with that decision. Even when it was $100 against me, I was happy with the decision because it's a time and place that essentially 9 out of 10 times, all those things lined up the way it did, I would do exactly as they did. And to me, that's trading with a discipline and understanding the models that I use and the pros and cons to them, putting all the pieces of the puzzle together, to have come up with that scenario.
So, Rick, overall, 2024 is a historic year for gold. Just look at that chart of how much it has run higher, broke above, let's say, that $2,100 number, and tacked on another $700 on top of that. But what stage of, I guess, bull market action can we consider gold to be in? Because it was, in a way, kind of a dead market there from that peak in 2011 the whole way through, well, cherry pick your time, but let's say 2020 before it really started moving higher here and consolidating some of these higher gains. Just how sustainable would another leg up, another pop higher be for the gold market?
Let me take a quick look here. I want to just pull up for myself a monthly chart because I was just looking at a weekly. I just want to see kind of within wave counts, where we would be within the scheme of things. So if we go back to, I don't know, 1999, 2000-ish or something, the bottom down there near 250. So one, two, I don't know, I'd say this is probably theoretically all part of the third wave that has hit, targets up. So you could get, I mean, in a scenario that I'm not anticipating, gold could fall all the way down to, I don't know, 2,200, something in that neighborhood, perhaps, before picking up again, and then ultimately getting perhaps one final leg higher that really could be a major thrust, the one that when and if Bitcoin ever went to $200,000 or something like that, maybe gold, gets its real big final thrust, and then it probably is done for quite some time.
All right, let's also talk about the gold stocks. Let's look at something like GDX, that Van Eck Gold Miners ETF. Look, that also trending much, much higher, higher highs, higher lows ever since that bottom in March. However, the last, let's say, month and a half has been a bit of, I guess, band-aid on that bullish chart as we have broken to some lower levels and also broken some key moving averages. A big difference between the gold chart. So how are you looking at the GDX chart?
So I actually like the GDX chart in a bigger picture. Unlike gold, however, the recent highs from this year didn't even quite match the highs from 2020, and they're well off. In GDX, the all-time high in GDX is, I don't know, 66, something up there. It looks like from a chart I'm looking at in 2011. So look, this is way off those highs, and there is, if you go back and you put up, I don't know, put up a 20-year chart so that you get really a long-term perspective, you realize that anywhere between roughly 40 and probably 40, the upper 40s, is the long-term swing area for GDX. It's where it broke down from in 2012, 2013, was what had been a head and shoulders top, and the neckline was about $40. And now we've come a few times in the last, since 2020, we've come 1, 2, 3, 4 times between 40 and 45. So you've got to get above, if you can make new highs now and you take out those 2020 highs, then GDX should ultimately challenge its all-time highs north of 65. But the base building and what it's done in the last 10 years, to me, is more suggestive of potential room higher over time. Now, there's a lot of people in the industry that look at the GDX versus GLD, essentially gold stocks versus bullion spread, and everybody's talking about that GDX should catch up. It hasn't. It still hasn't. I have a little bit of that spread on. I'm only down 1.2%, so I'm fine on holding it. But in general, I do think GDX has better chance for more significant gains at this point on a percentage basis than gold does. But the timing of that is unknown.
Wow, so it's a positive in your eyes that the gold stocks have lagged gold, as long as, I guess, it stays bigger picture in this more bullish scenario.
Yeah, I mean, look, it's not a positive up until now, but just looking at the possibility for GDX to ultimately go and test all-time highs, whereas gold has been flying. Some people would say obviously GLD was the much better trade over time, and sure, it has been because GDX is not even near its all-time highs, and gold, I can't count how many new all-time highs it made this year. But I do think at some point, and I don't say that for somebody to mock me and say, well, yeah, at some point, maybe in the next 10 or 20 years. I'm not saying that, but I'm saying that the way GDX is set up ultimately and the base building that it's done over the last 5+ years, I think it probably, if you can get it back above 45, it has a decent chance to maybe then it'll ultimately outperform gold. But I'm not sure what the catalyst is going to be, Corey, to get those stocks to, break out to the upside at this point. I don't know. And if it's gold moving higher itself to drag GDX higher, then I don't know if the pair is going to work. It's almost as if something has to happen to the valuation and the belief that miners for a long period of time, for some reason, have been misvalued and terribly undervalued to the relative performance of the bullion itself, to switch the mentality into people saying, you know what, ultimately, I'm better off owning gold stocks than I will be owning bullion itself.
Yeah, that's such a good point because clearly that mentality from investors is just not there right now. So who knows what it's going to be to change, but right now, watch that 45 level. Because the GDX and silver charts are pretty similar, I think. Is it a similar outlook for silver then? How much that's lagged gold and how it could be a positive, but again, it probably needs to break a certain level.
Yeah, look, silver is poor man's gold. It's always been, and it just doesn't quite perform the way. Part of it is the supply, part of it is the greatly reduced industrial demand that has withered in the last 20 years because of the advent of, let's say, digital cameras and photography that doesn't need silver anymore, a major component in film.
Oh,
So
but
you
I
have
keep
far
hearing
less.
about solar panels, and I keep hearing arguments that silver is still being used.
It's a much smaller. Think of this: the solar panel usage globally, as compared to what film usage used to be globally, is dramatically an insufficient argument to say that solar panels will be the reason why silver ultimately, you know, performs better. Everyone and their mother and father and grandparent, everybody had a camera at some point that used film. And you've taken essentially a global population's worth of usage of film out of the equation, and only minimal solar panel usage at this point. And certainly on a global basis, it's very minimal. So could it pick up over time? Yes. The gold silver ratio, is gold. There's no way you can fight that gold has been the better long-term investment. Silver's all-time high, $50, whether you look at 1980 or 2011, you both kind of got to $50 at both those, and silver's trading at $30 now. So you need a 66% return in silver from current price just to get to its all-time high, whereas gold is, virtually on its all-time highs, just minus, a month's worth of pullback.
Rick, what about copper then? Let's quickly talk copper, then we'll move on to markets. Copper has been slow and trending towards $4 a pound. Do you think it holds that level? What's your outlook for copper?
So copper is something I write about each week in my global macro piece for institutional investors. And I recently cautioned the supposed breakout in copper and the perceived increased China demand when China did their round of easing and stimulus, and Chinese stocks flew for a total of 3.5 seconds. I warned that the likelihood of seeing increased copper demand and that copper was going to keep moving higher was not likely at all. And I caution people about jumping on that bandwagon. And the reason in doing that was really because if you think about how much that China has already built massive cities where nobody lives, right? Tens of thousands of apartments just sitting empty in cities that have never been populated. The demand at the time for that copper to build piping and all the things that you need copper for in building a home has long been done. And I just didn't believe into the fact that the new Bank of China stimulus package that came out a couple months ago was going to give copper a lift. At the same time that you had that little minor lift from it, but it's all gone already, you happen to have trend exhaustion signals from some of the DeMark indicators that I look at. And so I've been nonstop just cautious. I have no position in copper. I didn't want to. It's fallen from, I don't know, 460 to 414 or so, where it is now. Certainly you could have shorted it. I didn't want to put a short on, but I simply said, this is not a market. If you're not in the copper industry and you don't need to trade copper, this is not a market I would want to really have anything to have to do with. So that's the best way I will tell you is it's just not a market you really need to want to trade. And if you don't have to, and you're not in the industry where you have to be hedging or forward buying, I would just keep away from it. You have no edge trading the copper market.
So do you think copper could make a more substantial run higher? It sounds like you're more on the bearish case where we could see a maybe sideways at best copper price.
Yeah, copper's been sideways for a few years now. If you talk about COMEX copper, every time you get to, I don't know, $4.75 to $5, you top. And, it's bottomed at, I don't know, 3.25, 3.5. And it's in a trading range. And I'm not sure there's a catalyst to get it out of the trading range. If at this point you get a couple of Friday closes above $5 and it holds there, then, now of course you're buying strength, but I just don't see your mid-range of a multi-year sideways pattern. There's no edge in trading copper.
All right, time to move over to the markets. Just as a quick summary, this month, we can say that the S&P, Dow, NASDAQ, and even the Russell, I believe, have all hit all-time highs. Some of them are a little bit off of those highs, but mostly it's been another good month for the broad averages. Rick, is the party just going to continue for these markets?
So first, let me say that the first three you mentioned did make all-time highs. Russell did not. It made a new 2024 high, but it is, I'm pretty sure we did not make a new all-time high, but I may stand corrected on that. And same thing, you've got some exhaustion signals up here too. I've cautioned clients, so using the IWM, the Russell 2000 ETF, I don't really have a case for it to get above 250 unless interest rates dramatically fall. And they've pulled back. We can talk about the 10-year after we talk about stocks. They've pulled back, 25 bips in the last week or two, but you would need a much bigger decline, I think, in rates in order to give the Russell a true lift to the upside at this point. In general, the stock markets, Corey, I've told you for I don't know how many months and months. I mean, all of 2024, my upside target in the S&P and the cash index has been 6120, and the spiders, that's equivalent to 609 and change. We got to 600. We're pulling back a little today. I think we're close to the place that, we'll see potentially as much as a double-digit percentage decline before ramping up again in 2025 or 2026 to new all-time highs and the final leg of what I would say would conclude the post-Great Financial Crisis bull market for a period of time where stocks pull back and consolidate. It's a long time that we've gone now. We had pullback in 2022 when the S&P was down 19%, NASDAQ was down, I don't know, something like 32%. But if you think back to the peak in 2000, the S&P sold off, I don't know, 50% into the 2003 bottom. The NASDAQ sold off, I think it was 74%, give or take. We're due for one of those at some point over the next few years, I think. Not sure, again, what the catalyst is. I mean, growing debt in the U.S. is always something that overhangs, and it only gets bigger, and And Trump might very well make it much bigger. And that's an issue. And I think that's part of the reason you're seeing, gold move higher besides inflation. But I think at some point here, so for now, I'm not gung-ho on buying stocks with the S&P at 6,000. For trades, if you're in and out type trader, that's fine. But as far as buying investments in stocks, only if you buy really beaten down names, may they survive, some near-term 5 to 12% pullback in the S&P without going negative on you, and then moving higher again. I'll tell you, I just bought a couple days ago for my daily tip sheet, we bought Regeneron. This has been a high-flying name that petered out over $1,100 a share earlier this year. I got down into the 700s, and we just bought it either yesterday or the day before. I can't remember. I paid just shy of 740. Names like that have been trashed, those I don't mind sticking my neck out. And if I can find a reason to buy them that's good enough to go plunk a bunch of money down on it, those I can believe in as possible investments over time. But buying Tesla after the rip it's just had after elections at current price, buying Amazon at 200, I don't know. Those, given that I think the market's likely to pull back, those I have less desire to be putting on at current levels and waiting more for a pullback. All Mag 7 names today, last I looked just before we started the show, are down today. It's not that often you see all 7 of them down. Tech's the big underperformer today. And it's just one day, so I can't make anything of it yet. But at current levels and being so close to my bigger upside target that's been in place since the October 2022 bottom, it has always been 609 in the S&P. So having gotten to 600 already makes it pretty tough to be a buyer up here.
Yeah, it's crazy just how good these markets have done, but it's flown in the face of a lot of the bears saying they can't keep going higher, and they have kept going higher. Let's talk 10-year then real quick, because middle of September, the 10-year bottomed about 3.6%, then went almost straight up to right around 4.6%, showing a little bit of weakness in the last about week and a half. Where does the 10-year and the yields broadly more go in your eyes?
Okay. So we spent the bulk of November kind of backing up right against the major downtrend line in the 10-year from the 5% high. So from the 5% high to the, I think it was about 4.74, the secondary high in, I don't know, probably June 1st or so this year, that downtrend line is what has rejected the advance now after a massive move since September 18th when the Fed eased. So in a textbook, buy the rumor, sell the fact, bonds peaked exactly the day that the Fed decided to lower rates, exactly opposite that what intelligence should tell you, but that's how markets work. So we go from 3.6 to about 4.5, stall against the downtrend line, and as you say, the last few days fall. I've got 3 key levels here in between the high we just made at around 4.5% to that 3.6 level. One is 4.22, and today's low is 4.23. So this is one downside target from the recent high. The second is 4.07%, and the third is 3.94%. My best guess is that rates do not go lower than 3.94 and probably bottom near about 4.07. So the bond traders this year have gotten really fooled multiple times in how the market's moved. Fed fund futures traders have been the worst. They came into this year pricing 7 cuts, right? We had 2, and maybe we'll have a third. And personally, I don't think we should have a third in December, but Chair Powell may do it. I think 2 is good right now, especially given the potentially higher inflation scenario that some of Trump's things can bring to the market. So I'm going to kind of play for a 4.07 right now target, at which point that if you've recently bought bonds in the last week or two, or you have them from prior levels, but that's where for tactical, that's where I'm playing the target. And it's interesting because while I look at it, not only is 4.07 a horizontal level off of the recent rally in October, but it's also where in the next week or so, the uptrend line from that 3.6 low is, and it's the backfill to a prior downtrend line that we broke above in the middle of October on the way up. And that's where so three unrelated things will come into just about 4.07 in the next week or so. So if we get there, that's where I kick out trades that I have on.
All right. Rick, great having you on the show. Again, Rick Bensignor, president of Bensignor Investment Strategies. Click that link in the show notes to visit the In the Know Trader website, where you can read over all of Rick's products for the retail and individual trader, all of which are very valuable to all of you listening that are active traders that actively manage your portfolio. Rick, thank you so much for taking time on this Thanksgiving version of the KE Report Weekend Show.
Corey, thanks for having me. Enjoy the holiday.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back to the KE Report Weekend Show. We are now shifting our focus over to the energy sector. I hope everybody enjoyed those first couple segments with Rick Bensignor, focusing more on kind of the metals and mining sectors. Now it's time for energy as we're chatting with Josef Schachter, founder and editor of the Schachter Energy Report. Also writes the Ion Energy Report, which is free and really covers the data that is being released on a very regular basis for the oil and natural gas sectors. Josef also does quarterly webinars for all his subscribers. He dives into company reports, answers your questions, and he's also running a holiday special. I'll post a link in the show notes so you can get access to that holiday special and also see the webinar replay from this recent Thursday. So Josef, thank you for taking time on this weekend show. Let's start off with some of the recent data and price moves for oil and natural gas. Oil broadly has been in a, let's say, sideways to downtrend, still holding that $65 level, but having a lot of trouble now just even in the low 70s to get above there. Natural gas is doing a lot better. It's at highs for the year, even touched its high from 2023, but still in a way not as exciting as it has been in a few years past. So Josef, key data from the energy sector, what's caught your eyes recently?
Well, the politics of oil are quite interesting in the States. You know, Trump's view is drill, baby, drill, and Biden has hurt the industry. And he has in the sense of not allowing access to federal lands, not allowing certain offshore drilling in the Gulf of Mexico, not allowing activity in Anwar and parts of Alaska. But the industry runs on economics. And if the tier one Permian and Eagle Ford wells are attractive, or North Dakota wells are attractive, they're going to put them on. So U.S. production on Wednesday, when we got the EIA data, was 13.5 million barrels, up from 13.2 a year ago. 13.5 is the record high number, so it's really done well. Exports are really taking off. The light oil coming from the Permian and the Eagle Ford can't be used in the refineries on the Gulf Coast because they use heavier crudes from Canada, Mexico, and even Venezuela, which is shocking. But the exports last week, 4.66 million barrels, up 285,000 barrels from 4.38 from the week before. And so you've got a very significant increase in U.S. exports of light crude. And a lot of that is going to Europe. Some of it goes to Asia. And so the American industry is, you know, when you take into account the consumption of 20.47, the U.S. produces 22.9 million barrels of liquids between domestic crude production and natural gas liquids, like we talk about condensate and other things in Canada when we add our numbers up. So 22.9 million is the U.S. production last week, U.S. consumption 20.47. So the U.S. is over 2 million barrels a day of excess capacity. And that's why you see these strong export numbers. And you see, of course, imports from Canada. And so this whole thing now of tariffs, I think it was a political thing for Trump to, try to get some attention before, and also to make the Biden administration look weak, which they've done a good job of doing on. And in return, the Canadian government is trying to have a united front. And there's not much fentanyl coming in Canada. There's not much immigration here. I think Trump would be very happy if the never-Trumpers leave the U.S. and come to Canada. He'd enjoy that. But he also probably doesn't want the illegal immigrants crossing into Canada and then sneaking back in. So the Canadian government's going to have to play ball there. I think the president of Mexico did a great job saying, hey, this is going to cost you America too. But right after that, she had a conversation with Trump, and Trump, mentioned it, that she is going to have the military come and close the border, just like they did at the end of the Trump administration in 2020. So I think this is just a political football, and he throws carnage, makes everybody upset, and then of course everybody then throws things back, saying, "Here's what we'll do. Don't attack us." And the people need to realize that the energy industries are so interlinked. If they say they're going to put a 25% tax on our heavy crude going to the Gulf Coast, to Midwest refineries, those Midwest refineries would not be economic, and they wouldn't find another source. So it would raise prices, and Trump has said he wants to lower prices. I don't buy at all that he's talking about cutting the price of gasoline in half. There's no way the industry can work at $30 oil prices. You need between 65, 70 to be economic. And if there's going to be growth in 2025, 26, demand growth by 1.5 million, 2 million barrels a day per year, then we're going to be looking at $90 prices at the end of 2025. And I believe over $100 prices for the WTI in 2026. So I think we got another few weeks of sloppy prices, 66 to 72. And then I think we're going to be looking at 70 to 84 in the first half of 2025, 90 in Q4, so 80 to 95 in Q3, Q4, but consistent over 90 in Q4. That's going to wake everybody up to the values in the sector, and I think we're going to see a potential doubles and triples in the sector, especially from those that are depressed, that have been beaten up during this tax loss selling season, where the fundamentals are good, the balance sheets are good, they had growth in volumes. And so we'll be covering that on our webinar and talking to people about what the best bargains are, and they can decide what fits their portfolio with their investment advisors and make the right decisions for themselves.
Well, Joseph, just following up on the political football in the energy space, a lot of people look at Trump as being big on cutting regulation, cutting the red tape, possibly allowing some of the drilling and expansion on the federal land. So I know one of the initiatives is to increase it by even 3 million barrels per day more than the 13.5 you just reported on. If we were doing 16, 17 million barrels per day of oil, what does that do to the price of oil if U.S. is already at record production levels, and then it spikes the football even further? What does that do? And then how does that relate to overseas producers like OPEC?
Well, it means that OPEC, if demand grows from 1.5 million to 2 million, and the Americans bring on 1 million barrels a day in 2026, because, you're going to have to drill it up in 25, put in facilities, bring it to the coast, the Gulf Coast. So if in 26 they bring on 1 million, 27, and then 28 1 million, there's your 3 million. But if the demand growth is 1.5 million to 2 million, it still leaves room for OPEC to bring on a little more production, and they're going to manage that so that the prices stay firm. So my view is that we will see higher prices simply because OPEC needs the revenues. When they talked about 2.2 million that they were going to bring on in December, now they're talking about bringing it on in 2025 when demand warrants. The reality is 2 million of that 2.2 is Saudi Arabia. The only other ones that can bring on minute amounts are Kuwait and UAE, and they're going to follow, the ball as called by the Saudis, so Aramco. And if people think there's somebody that's going to put a glut of oil on the market, the only way that could happen is if Venezuela's government changes and all the American firms that used to run the Venezuelan oil market go back in, and over a couple of years, you could see 3-4 million barrels. But at this point, I don't see Maduro leaving, and Trump is really not focused on them. He's more focused on Iran. And if he tightens up the economic, shipping, insurance, banking, and makes it harder for Iran to sell oil to China and India, then we're going to see it, them down in production by 1 million or 2, and that gives more room for growth for American and other OPEC production.
Joseph, real quick, then over to natural gas. That has been doing quite a bit better, as I said, reached highs from last year, but historically still not an overly attractive natural gas price. But the trend right now is in the bullish favor. Is this just due to some colder weather we've seen, or is this a more sustainable uptrend for natural gas?
Well, we've got colder weather, and Europe is seeing very cold weather. So, and the drainage of their storage is happening quicker. We've had a 30% increase in just the last couple of months in the price of LNG, and it's now in the 15 US to 17 US, depending upon the market. Prices in Asia are now over $15 an MCF. So you've got very strong pricing around the world. So if we ever get more LNG plants on in the US and we get our LNG Canada on in Q2, Q3, there's going to be some fabulous prices there, and that's going to lift Canadian. So US prices today are, $3.30. When I talk to companies that work in the States, they're all saying they want 350 on a consistent basis. They don't want 350 just for, December, January, February, which of course winter. And then in March, April, it goes down to $2 or $1. So a lot of them are holding off drilling or completing wells until they see a more sustainable price. So what we're going to be watching is the storage in the States, and the EIA reports those data points on Thursdays, and we're going to need to watch to see big drawdowns. If we see multiple weeks of 200 BCF or more and cold weather, Arctic fronts going down into Texas, that's what the natural gas energy bulls are looking for. And again, we're still in November. Usually those big draws occur late December, January, and February. So we're weeks away from it. But if we do see $4 or $5 spikes and big drawdowns, that will help the Canadian price because we ship gas into the States West. Right now, I think we're about $1.50. For a couple of months ago, we were under 50 cents because of the storage in Canada being full. But with winter here across Canada, storage is now being used. Gas is being moved from the Coastal Gas Line into the LNG plant, and LNG Canada is doing trial runs. So we're within 6 months of the Canadian story going from ugly to going to good.
Well, Joseph, let's shift over to some of the energy stocks now, just because when you look at the makeup of the larger producers, best represented by the ETF XLE, they're actually holding up really well. They're actually still up near highs in the valuations they're getting. But you mentioned earlier in the call here that you're seeing some real value in some of the smaller to mid-tier companies that have just been beaten down during this pullback in the oil prices. So maybe speak to the disparity and opportunity you're seeing between the large caps versus the small and mid caps.
Yeah, everybody when people, tiptoe into the sector, they're looking at CNQ and Suncor, and Cenovus has not been a good performer. As you know, if you look at the chart, it's not done well. MEG recently hasn't done well. So it's really, CNQ and CNQ and Suncor that are the poster childs for exposure to the Canadian oil and gas industry. Imperial Oil would be in that group too. But there's so many medium-sized companies that are below the radar of most portfolio managers, generalist portfolio managers, that are trading at bargains. And that's where I see tremendous value. And a lot of them have decent liquids percentages. And so you can find some bargains that are trading at under 2 times cash flow, under PDP, proved developed producing reserves. And historically at market tops, they're going to trade at the 2P reserves, and they're going to trade at 5 and 6 times or 7 times cash flow. So there's a lot of bargains out there. I'm going to go through, 5 or 6 of them on the webinar tonight. And I think people, should be going below the big, poster child names and looking at the value opportunity. And I think they're going to realize, You can buy a lot of great companies trading at 1.5, 2 times cash flow, with decent, balance sheets, with growth prospects in front of them. You go to the presentations on their website and you'll see how they look to grow into 2027, 28. Many of them are looking at pretty significant growth rates. And that to me is what you want, is to buy them when nobody cares. Tax loss selling season, we've seen that happen before, where the stocks get beat up in November, December. They have a good bounce in January, February, and then if we have a good sector in 2025 where we do see $90 oil, I think you're going to see doubles and triples and maybe some that even perform better than that. So to me, I'm recommending people take advantage of the bargains that are here now, between now and mid-December, because of tax loss selling. Tax loss selling is indiscriminate, because people who made gains in NVIDIA or Microsoft or any of the AI names or any of the semi names or wherever, they're going to have to pay tax to Ottawa. And as you know, the Canadian tax rate for capital gains is going up. They haven't passed the legislation, but we'll all be paying it when we get to April. So they're going to offset. People will want to offset with losers. So if a stock is trading at $5 and you bought it at 10, and you sell it at 475 or 465 or 455, you really don't care. You want to trigger that tax loss. And so I think the next 2 weeks are going to be a little ugly for it. But for those people who do their homework, find the names they really want to own, putting bids in below the market is going to be a very rewarding opportunity.
Hey, that argument to go down to the smaller companies makes total sense because of how well these large companies are doing. But Joseph, why are investors so interested in these large oil and natural gas companies when the price has been so boring? I realize they're making money, but again, they haven't been seeing the growth simply from the underlying commodity price. So is it just that potential Trump policy where these companies could tack on a bunch of growth in the near term?
Well, if you remember, CNQ bought out Chevron. So there was a very big transaction that grew that company. And of course, you've seen a lot of normal course issuer bids from Imperial Oil. Suncor is doing an NCIB, raising the dividend. The new management team there has got the company back on track. So it's easy to, as a portfolio manager, to say, if I want energy exposure, I'll buy CNQ and Suncor, and I've got my weighting, and then maybe you buy some of the pipeline infrastructure stocks or royalty trusts, stocks like Topaz has done extremely well. You can find names, Enbridge has done well, TC Energy has done well, Pembina has done well. So if you go into those places, you can have good performance, good dividends. And historically, the pipeline and infrastructure stocks raise their dividend in Q1 of the following year. So in Q1 of 25, they'll be raising the dividends again, maybe 4, 5, 6%. So again, that's a good place for a lot of people who need income to go. And that's why, and they're very liquid names. And that's why the portfolio managers are focusing there. But historically, once you get an energy bull market running, everybody starts moving down and says, where are the bargains? Who's drilling and finding new reserves? Whose balance sheets are great? Who's going to be able to raise their dividend? Who's going to be able to have an aggressive NCIB? And that's where when you see the big doubles, triples, 5 and 10 baggers that we saw in the 2008 cycle, we saw some stocks up 20, 30%, 20, 30 times during that cycle. So again, take advantage of the dips during these super cycles. We think this one started in 2020. We got up to $120 during the Russian-Ukraine invasion. We backed off to 66. I think, as I said, I'm looking at 90 and then 125, 26. And if that does develop, we're looking at significant moves to the upside.
Well, Joseph, just building upon that point, if we do see $90, $100 a barrel oil, and you see the sector start taking back off again for the next leg of the longer bull market that's unfolding, do you think that the small to mid-cap stocks that are focused more on growth, on drilling and expansion, will have the leverage, or are investors still looking for that share buyback and dividend aspect to the company as well? What do you think is more important for driving interest, I guess, in a speculative market?
Well, I think what longer term is going to be exploration. So people are going to want to see growth, but that's when we're $100, $110, $120 oil, the market's going to say, pay me, I want to see growth. Right now, markets want to see return to shareholders. So they want to see NCIBs, they want to see dividends. And, and so they want to see free cash flow, and they want that cash flow, that free cash flow, a third of it to be used for lowering debt and internal growth, and then 2/3 returned to shareholders. And a lot of companies are doing that. And the ones that have done that have received, some reward from the market, but they're still very cheap relative to where they can be. And I think that as we, start getting into those higher commodity prices, people will be saying, okay, we know you've got a good balance sheet. We know you've got good assets that you can grow. We want to see growth, not 5% growth. We want to see more growth. And the basins in Canada can do that. We're going to pay you for growth. Now go spend more than cash flow drilling and growing faster. So again, that's going to be something that's later in the cycle. At this point in the cycle, people are still in their bomb shelters, because of how bad things were. And of course, you had a nice bounce from 2020 to 21. But since then, we've had a 2-for-1 sale, crude oil 120 down to 66. So we're looking at, people being very uncomfortable taking risk in the sector. And yet the value perspective has never been better in my book. I can find a lot of companies with great balance sheets trading under 2x cash flow, trading at a quarter of their 2P NAV, trading at or below PDP, which is what the banks lend against. And as somebody who's followed the sector for a number of decades, we haven't seen bargains like this very often. And historically, those bargains don't last very long. And if I'm right, by the second half of 25, people will look at the prices now versus where they are in Q3, Q4 and say, wow, wasn't that a great one?
That's so crazy to see, or for you to see all these bargains out there when, again, we have the major oil producers, natural gas producers. The XLE broadly is still trending right around all-time highs. So clearly, I guess there is an opportunity here. Joseph, what about those investors that don't want to take individual company risk? Is there an ETF? Is there a basket that you would recommend these individuals buy that give them exposure to these smaller energy companies that you think have the best upside potential?
I don't spend a lot of time on the ETFs. I'll have to pass on that. But there are ETFs from Horizon, from the banks, from different developers. So people can just Google Canadian energy ETFs and then look at them and look at the liquidity of them, look at the day trading, in terms of the volume. If you do it, I would want to recommend that you do it and invest only in those that have some liquidity. And also, you might want to be in one that includes both energy service as well as E&P. So again, I'll leave that to others who have that expertise. That's not something I spend a lot of time on or any time on.
Well, Joseph, I know you spend time on looking at the oil services side of things, so looking at pipelines, looking at drillers, looking at other companies that support with tech the oil and nat gas space. You've already alluded to a few of them, but any companies that really are on your radar as a good value here?
Well, let's start with the drillers. I'm a big fan of Ensign and Total. They've done very well for people, and the Q3 numbers were very good. If we continue to see a pickup in activity for drilling, especially as we move with more projects being approved on the West Coast for the LNG plants. So I think that you want to have some exposure there. I'd be looking also at, tool companies, McCoy Global out of Edmonton. There's others, some people like Enterprise Group. So there's some names out there that people can look at. I'd be recommending people not only own Canadian E&P, but Canadian companies working internationally. Gran Tierra announced a very nice discovery in Ecuador yesterday. The stock had a nice bounce from that. You saw probably yesterday that Valeura announced a nice discovery in Jasmine offshore Thailand. So there's been some very good drill results, and I think that's where historically the biggest returns have come from those companies that are explorers and that come up with meaningful new reserves, and then within a reasonable period of time bring those onto production.
So, Joseph, are we missing anything? Are there any other companies here that you want to bring up to us that you see maybe even more so as near-term opportunities?
Yeah, I'd be looking at companies that missed in the quarter because they shut in gas because natural gas prices, especially dry gas, was you didn't make any money. Varen at the high was 1267. It's now 744. The 52-week low was 684. So, that stock is very, very cheap. I'll give you another one, Obsidian. trading at 804, the 52-week low 731, the high 1237. So very cheap name there. And then I'd give you Bonterra, trading at 337, 310 was the low, 687 the high. So you can see there's been a lot of 2-for-1 sales out there. Alvo Petro, which is in Brazil and gets a very high price, pays a great dividend, balance sheet is strong, no debt, 438 today, 381 was the 52-week low, 764 the high, and you're getting paid a very nice dividend. They have no debt. So there's bargains out there, tremendous bargains, and I'll be spending a lot of time on them on the webinar. So if any of your clients can't, it's past the weekend, we have an archive. We put the webinar in the archive a day or two later. So if they become a subscriber, they can get into the archive and listen to it thereafter.
So I mentioned it on the onset, but just remind everybody what this holiday special is all about.
Yeah, what we do is for December, our manager subscriptions puts in a holiday special. And so for the annual, it's HOLA 24, so HOLA 24, and it's $100 off the normal $9.99, so it's $8.99. And then for the quarterly, for people who want to get a feel for it, the better deal is the annual. So take it for a quarter, see that you like it, and then switch to an annual. That's $50 off, so it's HOLQ 24. So $50 off from $299 to $249. And if you can, please join us for the webinar, in the archives, and then hopefully, our webinars that we have in 2025. And please take advantage of the bargains that I talk about on the show, depending upon what fits your parameters. Please, as always, talk to your investment advisor to see what is appropriate for you so that you're not taking risk that's inappropriate for your account.
All right, that wraps up this weekend show. Joseph, as always, great chatting with you. Thanks for the rundown in the energy sector. Everyone listening, I hope you enjoyed this weekend show. I hope you all, at least all of you Americans, had a very happy Thanksgiving, spent time with your family and friends. And just as a reminder, please go back through our website, kereport.com, or podcast. Just search The KE Report to listen to all our daily editorials and company updates from throughout the last week. Everyone, thanks for tuning in this weekend. Joseph, always great having you on the show.
My pleasure. Thank you.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.